Welcome to Macro Minds, where I talk to economists and other experts about the issues of our time. Welcome to Macro Minds. This will be the final episode of the year. Today I'm joined by Chris Watling, the global economist and chief market strategist at Longview Economics. And we're here to talk about debt supercycles and whether or not the US market is now a bubble. Can we say that with some confidence? So a slightly odd starting point perhaps to think about debt supercycles, but we're going to begin with the UK housing market, which is where I think this story starts. We have a new Labour government that is looking to lift the housing market, and it has taken what is probably the conventional view in the UK, which is our problem is a lack of supply. That's the reason houses are so expensive. This is the reason people are so unhappy about the cost of buying a house. But Chris, you have a slightly different view, so perhaps tell us a little about that.
Yeah, absolutely. Yeah, great to be here. Thanks for having me on. And you're quite right. The sort of UK is an example for the West and the way the debt supercycles developed across the West. But yeah, I mean, to address it from one angle straight off, which is the Labour government point that you need to build more houses. I mean, it's pretty clear if you look at the numbers that we've got more houses built in the last 10 or 20 years than we have new people. It doesn't feel like it in the last couple of years because if you think about the last immigration last year, 700,000, 600,000 the year before, whatever the number was, it feels like a lot of people, of course. But those numbers are exceptional. If you look over the last 25 years, average net migration to the UK is sort of 250, 300,000, 400,000, depending on how many decades you include in there. But even if it's 400,000 per annum on average, the average household size has been for 3 or 4 decades, 2.4 people. So divide 400 by 2.4, and you need less than 200,000 new houses, which we have built on average over the last 20 or 30 years. So there's a ton of ways you can prove that side of things. I think the more interesting side is, if that's correct, is not about a lack of physical houses. It's about financialization. That's what I think's been going on really in the system. And there's been massive growth in mortgage debt over the last 20 or 30 years, much faster than growth in GDP. And that was the primary driver of the debt supercycle across the West. And in fact, it's a story that goes all the way back to the 1970s or even earlier. And I like to think of it as I call it from a mortgage queue to an eighth. So I'm in my mid-50s. My father is in his mid-80s. Him and many others who I speak to of that generation tell us about queuing for a mortgage in the 1970s and 1960s. You go to a building society. I'm sure you've heard these stories. You stand in a queue. You wait your turn. Once enough money's been saved into the building society, you're next in line as long as you've demonstrated good standing and all that sort of stuff. And that's how it worked until we had financial deregulation, starting with Thatcher and Reagan in the early 1980s, where they started to deregulate the financial sector, and then progressing all through the Basel Accords, which was a sort of a Western/global form of regulating the banking system. So the key here is we came off the Bretton Woods, which was the sort of more modern version of the gold standard, slightly looser in the early 1970s. And then we got to a different form of regulating banks, which was Basel, which allowed them to buy building societies and most importantly allowed them to create money. And of course, it's not that well understood that when a commercial bank makes a loan, it creates money. And what governs the amount of lending they can do now is really how much capital they have and other ratios like liquidity ratios. So really that's how we got into this. That's how we started getting into it. Commercial banks, and I always like to say, if you look at Barclays Bank, for example, if you look at their annual report in 1980, it had 0 mortgage debt on the balance sheet. If you look at the British banking system today, you look at the loans to the UK by the commercial banking system in its entirety, and we know that's mainly 4 or 5 banks, it's about 60-70% of their domestic loan book is mortgages. So they've gone from 0 to 60 or 70%. And as I say, you've gone from a mortgage queue where you had to wait for someone to save the money to a situation where it gets created. And actually, the reason I say a mortgage queue to an eighth is because the way, and I'm not explaining the full system because I know we're gonna develop this, but as you go through Basel Accords 1, 2, 3, and I think we're on round 4 now, the amount of capital required by a commercial bank to be held against a mortgage has gone from starting at 50% with Basel 1 and through Basel 2, 35%, and such that the big banks in Basel 3 and 4 are allowed to do their own calculations. So they're down to about 12%, which is an eighth, 12.5%. So it's from a mortgage queue where you queue and wait for someone to save it to a commercial bank that creates the money and needs 1/8 of the value of the loan as capital against it, as opposed to if it makes a corporate loan as a commercial bank, it needs 100% risk weighting. So they're incentivized to make mortgage loans, not commercial corporate loans. And that's really, I think, the main driver behind very strong house prices across much of the West.
Okay, so there's a concept in economics, effective demand. Of course, we demand lots of things. Whether or not we can actually afford to pay is a completely different thing. And so the way to think about effective demand in the mortgage market is, well, can I afford the loan? So if I understand, we go through, let's take the past 100 years, and actually for most of that period, just mechanically speaking, based on population growth, we've been providing enough accommodation through net additions to the housing stock. But then in the 80s, roughly speaking, something changes. All of a sudden we get an acceleration in house price growth. Most people think that this is due to inadequate net addition, so not enough supply. But the argument here is, which is compelling, that actually effective demand is increasing. That's what people are actually willing to pay. So am I right in understanding the following? So if it's 1965 and I want to buy a house, the lender has to have that cash in the bank in order to hand that over to me. That's the gold standard, where there's a nominal anchor. There's some limit on the amount of money that can be loaned out, and the limit is how much money is being saved. When we move to a fiat system and this new regulatory environment, all the bank needs to do in order to issue the loan is meet the capital requirement. And so this is the thing that I think people don't understand. Suppose the bank issues a loan for 100,000. If the risk weight is 13%, they only need £13,000. The
Exactly.
87,000 is newly created money. And if someone pays a loan down for 50,000, that destroys 50,000. There's an interesting.
Well, in fact, the 100,000 is newly created money.
The 100,000, that's right.
The whole 100,000, and the 13 is the capital on which they're allowed to leverage up, if you like, and create it.
And so banks earn a profit on this lending, and to a certain extent, they've been flushing the system with loan after loan after loan, which has pushed up effective demand. And so the pricing power in the housing market has gone up as this effective demand has increased, which is, even though it's just money, but it's capital misallocation and debt misallocation.
Yes.
And it comes at the cost of other loans, which I think is the point then you move on
it
to.
comes at the cost of other loans. And part of the problem is that it's, we only have limited pools of capital in this country. And the deposits in the banking system, of which, this is linked. As I say, when you make a loan, you create new money. That becomes a deposit. But basically, previously to this situation in the early 1980s, if you go back to the 70s, 60s and beyond, money in the banking system would be channeled into the corporate sector. And it would do, hopefully, something productive. Whereas, of course, any money that's channeled into housing is not productive. It's an unproductive asset. And really, that's, as I say, our banking system is one of our key pools of capital. Obviously, insurance companies have big pools of capital, and people save into ISAs and all that sort of stuff. They're all great pools of capital that can do something productive. But this is one of the big ones, and we're wasting it on mortgages and house prices.
And the risk weight is lower for housing compared to corporate. And how big is the difference?
So the risk weighting on mortgages these days is about 13%, 12 to 15%, depending on how the bank does it, calculates it exactly, and how much loan to value. On corporate loans is 100%. It's a completely different number. So the commercial bank is not incentivized to make corporate loans. And
even if you're lending on secured
well,
finance?
yes, I believe so. Yeah, I think most corporate lending is secured. And in fact, ironically, when I looked at the commercial banking's loan book in aggregate a few years ago, to be fair, but it won't have changed that much. If you look at the commercial banking system's total UK domestic loan book, as I said, about 65% of it's mortgages, another 5-10% is consumer credit, and the rest is corporate loans. But of those corporate loans, about a third are to the property sector, to build property. So most of it, sort of 70-80% of their loan book is into property and real estate, basically.
So what's the overall limit of the amount of loans that you can make in a fiat system? What controls the loans? Because once it's the distribution within some limit which is skewed towards housing. So where do those limits come from?
Well, I think in a sense it's sort of governed by your current account.
Yep.
If you're basically, I like to joke, what does Britain do? We create wealth effects in housing by lending too much money, and we go out and shop. I mean, of course, there are some brilliant things that happen in Britain. There's no two ways about it. But when you go out and shop on the back of wealth creation and financialization, you create a current account deficit, and eventually you have problems as a result of that.
And you make a link between this shift in the monetary system and the decline in productivity, the chronic underinvestment, and the widening of the current account.
Absolutely, and in fact, there's some wonderful analysis one can look at if you look at the household savings ratio, for example, in Britain, and it's not dissimilar in some of the other Western countries. Ours is probably one of the most obvious. Roughly 2/3, 70% of growth is really about a falling household savings ratio from the beginning of one cycle to the end of the cycle. And that's been the way it's been very much since the end of Bretton Woods. So in a recession, the savings ratio goes up. People cut spending, they panic, they lose confidence, they save more. The negative effects feed back into the economy, the recession plays out. And then you start the recovery with a reasonably high household savings ratio, and it falls over the course of 6, 8, 10 years and whatever, down to a very low level. And of course, that falling savings ratio is really driving a widening current account deficit. But if you look back pre-Bretton Woods, you'll see that our household savings ratio is really pretty stable. And the cyclicality in the economy was more about inventories, business, not really about household savings up and down and confidence crashing or rising or a wealth effect. It was a very different economy. So, and I think at the heart of what's happened is really the financialization story. I mean, I think it's really the guts of it. And it does feed into productivity, as you say, because whole pools of capital aren't going to productive uses. And
is it to say that lending to the housing market, you think, is essentially crowding out the lending that should go to corporates for productivity enhancing capital investment?
Well,
is that the way to think about it?
I think so. I mean, obviously if you're a large business, you can borrow off the markets, so it's no big deal. But, I don't know what the exact number is, 60-70% of employment is small and medium-sized businesses, maybe higher. You probably know the number, something like that, isn't it? And I'm a small business. There's no way I'm borrowing off markets. If I want to borrow, I need to go to a bank or probably one of these new sort of ETF type lenders. But yeah, I think it's basically a change in function of the commercial banking system.
Interesting. Because I think most people see lending into the housing market and realize this is lending into unproductive assets. I think the innovation is, the insight is this. It's actually that it's not just that lending into the housing market is unproductive. It's to say it actually takes away from lending that would be productive. There's a piece missing.
And it spends a lot of time and effort spent on real estate sector that needn't be. So
too much inflation of house prices has all sorts of economic and social negative effects. I mean, could we not keep the fiat monetary system and just say to central banks, house prices are now included in your measure of inflation?
Well, I mean, that would be better than where we are today.
Yeah. What would you prefer?
That would be an improvement. Yeah, I don't know. It's hard to say exactly what the perfect answer is. I mean, I certainly think that's a good starting point. I think clearly, I just remember starting out as an economist in the 1990s and looking at the money supply data, and I used to scratch my head because I remember it was always growing at 10, 15%. And I used to think, well, why doesn't anyone ever talk about this? Because, of course, I was trained at university in the 80s when we were all obsessed with monetary metrics. And Nigel Lawson used to try and measure them all. And then we had all those problems, as we were talking about before we came online, that when you measure, the Goodhart's law, isn't it? You measure something, it stops doing what you think it's going to do and all that kind of stuff. And I think a very important point here, and I actually think we just demonstrated it in the pandemic. The reason monetary metrics have failed so badly is because we financialized the system. So what are you really measuring when you're measuring M3 and M4? You're measuring credit growth. So you financialize the system, that's never going to give you a correct read. And of course, whenever you create a loan, you create a deposit. So M1 and M2 basically measures deposits. So they're going to be distorted. So of course they didn't work. In the pandemic, we created money, and when in people's bank accounts they spent it, we got the most classic piece of monetary inflation I've seen in my working career, I think, in the West. So, it's not monetarism doesn't work. It's just we've been mismeasuring it and misunderstanding it. So to your question, what's the best approach? Well, I think we need to sort of somehow limit the amount of credit growth to mortgages. I personally think what we need to do is change the risk weightings on mortgages over time. You could clamp down and go back to a monetary system that has an anchor for liquidity, like the gold standard or Bretton Woods. People today get excited about Bitcoin for these sort of reasons, and I can see why they get excited about it and why it's come into being. Whether or not it's a real thing or a bubble, I find very difficult. I wax and wane, but the reality is, if you start controlling the risk weightings on mortgages, you can control the amount of mortgage debt that goes into the economy, and we can slowly deflate what is really driving wealth inequality in this country, generational inequality. I mean, these are huge things, aren't they? And I think this is all at the heart of it. This is the main factor, and the poor productivity growth. So,
I mean, the challenge is always just to see the last 50 years where we've used fiat monetary systems, and we've seen this huge improvement in global living standards. And the great advantage of a fiat system is, in a crisis, you can do an awful lot very, very cheaply. Of course, there are always consequences, but policies like QE, which were very important through the initial phase, were only possible because of the fiat system. It's just, I think, to integrate the negative consequences you can have for real assets like the housing market, you need to capture the fact that consumer price inflation is not the only failing of a fiat system. If it goes too far, it's actually is more broad based, and I think you can make that more broadly for assets. You can include equities, you can include other risk assets. I guess the challenge is that the more things you incorporate in a central bank inflation target, the more complicated policy making becomes, whereas this kind of narrow focus on consumer prices at least just allows you to focus on the real economy. I mean, I think you're right. The solution is macroprudential tools. The question is, how do you go about it and at what speed?
Yeah, but I think there are arguments on both sides. You could do it very quickly and take the pain and then move on and clean the system up. Or you could do it over 30 years, which is probably more palatable for politicians, and quite a lot of the population might see it as more palatable, although I think you're better off getting it out of the way. But you're quite right. The other thing you could target, of course, is you could encourage the central bank to target a current account that's in balance broadly. That's not, if you look at our current account deficit, as you'll be wholly aware, most people will be aware, we've been in deficit basically since, I forget the 70s or 80s, continual deficit. Maybe 1 or 2 years we got back to balance. Which means that as a country, we're borrowing more than we're earning every year in, year out. So and people, you're quite right. People think 50 years seems to work quite well. I like to think 200-year cycles. And I'm a great fan of David Hackett Fisher. I don't know if you've come across his book, The 200-Year Price Waves, and where you get a period of stability for a long period of time, then you get a sort of slow deterioration, then you get the crisis phase. And if you think about Britain in the 1800s, in the Victorian times, it was price stability. Literally, what you paid in 1800 what you got for a pound, you basically got for a pound, shilling, and pence or whatever. Same price 100 years later. So prices didn't change, and it was a great period for British growth, very fast growth. Yes, we still had booms and busts and crises, but actually, a lot of price stability and a much better system. And then in these long waves, you then slowly deteriorate post sort of World War II, and then really we're in the crisis phase, I would argue now. Whereas if you look at a sort of price index, it's flat, slowly up, and really it looks like a Bitcoin chart.
That's right. Yeah, it's kind of what's the hockey stick. I mean, the challenge is with pricing in modern times. In modern times, there's a lot of downward stickiness. I mean, whereas you go to you look at an economic series for prices 150 years ago, and they increased quite as often as they decreased. Whereas today, prices tend to move up, and it's relative prices that allow the economy to adapt to circumstances.
Yes, it's like classic the last 2 years, 5 years, pandemic up, and inflation's under control because we've gone flat, or not quite flat, but it's and people feel that's of course Trump's one of the reasons he got elected. People are like, well, you say inflation's under control, but actually
prices are high and people realize it.
Yeah, we go to the pub, we pay £7 a pint. My kids are furious about it.
Well, speaking of the US, I think that's a nice segue to our next topic, which I was in the US last week, and in one sense, I'm sort of happy with what I saw. That you clearly have a proper economic boom there. People are feeling exuberant.
Where were you in the States?
I was in Chicago and in New York.
Okay,
and.
Yeah, New York's crazy.
It's crazy. Any economist that knows a little history knows the kind of things that people say when you're at the late phase of a boom or when you're in a genuine period of market exuberance. I've written it down so I don't get it wrong. But 9 days before the 1929 crash, the famous economist Irving Fisher said, U.S. stocks have reached a permanently high plateau. Yeah. And while I was there, I heard, well, it's a different economy now. It's a more services-based economy. Or the big tech companies, they have earnings today. They didn't have earnings in 2001. It was some variant of this time is different. And whilst it's nice to finally see a Western economy have a genuine business cycle upswing. I'm happy about that as an economist. We don't face a sleepy economy as far as the eye can see. But then it wasn't welcome, but I was reminding people, you have a 7% fiscal deficit. The Fed is cutting interest rates with inflation roughly at 3%. The economy's been growing at 3% annualized. This is an economy that policymakers have essentially goosed. Stocks look expensive. Yeah. And, before I go on, I'd like to get your impression. But yeah, on the one hand, it kind of makes me nervous. On the other hand, it's like, well, it's nice to see a good old-fashioned business cycle again. It feels like a long time coming.
Well, I mean, in a sense, you're right. But yeah, I think it's very goosed. I mean, you make the point with the deficit. 4 major fiscal packages in the last 4 or 5 years, chips, infrastructure, IRA, and then the sort of pandemic stuff. It's an enormous amount of goosing. Enormous, absolutely extraordinary. And of course, everyone knows that, there are no charts where the unemployment rate's at 3 or 4 and the deficit's at 7. It just doesn't happen. It's completely wrong way around. And actually, I think what's really interesting, I agree with you. I was in New York a few weeks ago, and on a Tuesday night, I went to a steakhouse, quite well-known one. There was literally no room inside. I was staggered. It was rammed on a Tuesday. Maybe New Yorkers like going out early in the week. I don't know, but yeah. So I think, if I really think about it, I think under the surface, and of course New York's going to look good because it's financial markets and they're doing well. So the city should be doing well. But I think the U.S. economy has got a soft underbelly, and that's what worries me. I think it's been goosed by fiscal, and it looks to me like this fiscal is going to dwindle over the course of 2025. Of course, there might be a fiscal stimulus package out of Trump and his team, but if that comes, it's probably the end of the year. And the first thing that happens is tariffs, which are really deflationary, ultimately. Their price level inflation jump, as you know, but actually they're taking money out of people's pockets. So they're deflationary that they can buy less. So they hit an economy with a soft underbelly that's not good. So I think if you look at manufacturing, it's flat for 2 years. If you look at housing activity, not prices, activity, it's basically in a depression.
It's not broad-based, that's right. Services looks very, very strong, but manufacturing in the US is just, well, I didn't check the PMIs today, actually. Perhaps I should bring them up, but recent PMI data out of the US has been not quite as weak as in Europe, but weak, below 50, as it is for the rest of the advanced world.
Yeah, the services was strong, but I'm not sure about the... But this was S&P, wasn't it? Not ISM, which I always think are much better. But yeah, I mean, and you know, we do sort of weird things. Look at sort of trade payables in the US. You have a nice series on.
The S&P manufacturing surprised to the downside actually in December. The preliminary was 48.3. Market was expecting 49.5, and previous month it was 49.7. Yeah. But services was ultra strong, 58.5.
Yeah,
3 points above what the market was expecting, and 2.5 above previous. Yeah. It's domestic.
It's weird, isn't it?
It's weird.
It's a fascinating economy because it's very unusual. Because, like you say, there are parts of it that are really poor, and then of course you've had all the AI capex, and you've had sort of the fiscal that seems to make it quite strong. But as I was saying, we look at things like trade payables. If you look at trade payables across the US, they're flat for 2 years, and in nominal terms, this is very weird. Trade payables, basically, how much does companies owe other people? When business is going well, you owe more because, of course, you're growing and so on. When trade payables are flat, it tells you it's like the economy's stagnant. It's very interesting because if you look at the earnings, the net income growth of the S&P 493, so take out the Mag 7, that is flat to down on 2 or 3 years. So most of the economy is not growing its earnings. It's not growing its bills because it's not growing. We talked about the sectors of the economy, housing, manufacturing, so on, they're flat. So if fiscal does dwindle, it's a real issue for the US, and I think it will in the first half of next year. So I think it's going to be fascinating first half.
Speaking to that fragility, in August we had a couple of labour market reports which disappointed the market, and confidence evaporated over a few days. Yeah. Economists were sort of wondering whether or not to downgrade their forecasts and say, okay, perhaps the recession's here. And in fact, actually, we found out we were 3% annualized or something in Q3. But it just goes to show. I mean, and when I look at various valuation metrics, let's take the Warren Buffett indicator. Let's divide the US stock market by GDP. It's 2.4 times. It's totally unusual. Of course, you look at the top end of the S&P and the Nasdaq, and price to earnings on a forward in the mid-20s. These are huge valuations. Yeah. And when I look at you've mentioned policy, but if I look at the long end of the US bond market, 10-year rate is trading at 4.3, which is growth of a bit more than 2%, 2% inflation, and a small amount of term premium. There seems to be an implicit lot of trust at the long end of a bond market for a government that's running, you mentioned, 7.5% deficits at 3% employment. Yeah. In what ways could this go wrong? How would you expect things to play out? I think base case is they probably muddle on as they do in America. But what does a reasonable downside scenario look like for you next year for the US? And what does an upside scenario look like? Yeah,
I mean, well, I think the biggest risk is a mid-cycle slowdown, which normally comes with a big crack in the stock market, which could be 15 or 20%. I don't think we're going into a major bear market. We could do, and that's definitely something one needs to think about, because I totally concur with all your valuation points. There's a million ways of showing it.
Yeah, that's right.
It's definitely true. I mean, and I think that you mentioned the forward PE ratio, the forward PE ratio of the S&P 500 is 23.5 times, I think, on the way we think about on 12-month rolling forward consensus. And in 2021, it was about 23 and change. In TMT peak, it was 25. So we're about those are 100-year peaks. Or the Shiller PE ratio. People don't like that. They think it doesn't work anymore. It doesn't make sense. But actually, the Shiller PE ratio is the same as it was in 2002, almost as high as in the TMT. Way above the 1929 peak. You mentioned Irving Fisher. I mean, forget that. That's chump change. So it's clearly a very expensive market. And we get all these arguments that you articulate. Well, it's all tech. It's all intangible balance sheet assets. Yep. It's not a proper measure anymore. But actually, if you look at the equity risk premium of the US stock market against real cash rates, which are both pretty straightforward metrics. Mm-hmm. Equity risk premium is an upside down PE ratio, basically. Less a real cash rate gives you gives you that. It's more expensive than the TMT peak. So, I can now find, for the first time since the TMT, you can find valuation measures which suggest the US market is even more expensive. So the downside risk is clearly there. And Hussman, who's been a great bear for way too long, John Hussman, people might follow him on Twitter. Unfortunately, he's been a bear for way too long, and that's not good. But he did make a terrific point in the FT last week. He wrote an insight opinion that non-financial margins in the US corporate sector haven't changed in 100 years. They've never made new peaks, and they're not really making them now. So I thought that was kind of interesting. We're in a new era, but we're not really in a new era. The cycle comes and the cycle goes. There's always a tech new era every 20 or 30 years. Fine. And the market gets carried away. But how do you time the end of it? I don't know. So I think from my perspective, I prefer to think about indicators that show whether the bull market is tired or not.
Okay. So what does that look like?
And that they are ticking the box. The bull market is tired. And one classic way of looking at it is simply looking at traded volumes in something like S&P E-mini contracts. Yeah. So how much are people engaging in this market? And I always like to say asset prices tend to trend for 2 or 3 years. And when they start and then they roll over, they clean out and start again. If you look at volumes back in 2022, October 2022, November 22, early 2020, very, very high as this bull run comes out of its October 2022 lows. And basically they've trended down for the last 2 years. And in fact, since the election, they've just fallen off a cliff, which I think's weird in the sense that as you were in New York, I was in New York, the narrative, the excitement about Trump, the excitement in the markets, they've gone up. They're going up on thin air. They're going up on no volume. And this volume fall off tends to happen before the end of every 2-year run. So the participation is poor. You can see it in breadth indicators as well.
Yeah, I've seen these narrowness.
Yeah.
So this plays out. I am just for our listeners. I mean that's my base case. Kind of mid-cycle slowdown in the US. I think a good outcome next year would be around about 2% real GDP growth at moderate inflation. Expecting about 4 cuts from the Fed with one this week. Question for me is if the US has a correction in the equity market, valuations are too rich, what then happens next? Does the market look elsewhere? Does it spread its bets? Does it look to cheaper markets? Or do we have what we had in 2022, which is the US market then just runs back up again? What would you expect to follow?
I would expect, most mid-cycle slowdowns and breaks in the stock market for 3 or 4 months to reflect that are accompanied by a change in sector leadership globally. Okay. So I would expect that because to my mind, if we're going to get this crack, it's going to drive rates lower, rate expectation. You're going to get more cuts than the market expects. 10-year yield's going to go lower. And it's going to kickstart a cyclical re-acceleration the other side of the mid-cycle slowdown. So where we talked about the S&P 493 having no net income growth for 2 years, that will change. And I think money supply will start expanding, earnings expectations will grow, and sectors will rotate.
Like the UK that look a little bit cheaper to start moving higher? Would you expect to see inflows or what?
Yes, I would. I would. I think anything in the world that's cyclical, consumer cyclicals, banks, old economy, value, they're going to start doing well. So in the US, obviously the S&P struggles because it's got so much tech in it on a relative basis. But mid and small caps do well. Russell, S&P 400, 600, UK FTSE 250, 100. And lots of these markets like this around the. One of our big picks has been Spain this year. Okay, it's a bit random, but actually it's a really interesting economy.
It's been performing well. Spain
done very well.
Done extremely well. Would you expect to see a weaker dollar in that environment then?
Yes, I would. Yeah, I would, because I think a cyclical reacceleration driven by the consumer and housing, which is what will happen in the US and the UK, I think, with lower rates, will drive a widening current account deficit. And in the US, when you've had a widening current account deficit, it tends to be dollar negative. It's a return to the noughties.
So there were so many questions around what kind of policy choices the incoming administration make. What exactly will Mr. Trump do? I mean, it's conceivable actually that through a little deregulation, through corporation tax cuts, through planned income tax cuts, certainly if Europe and China strike a deal and avoid the worst of trade tariffs, what you actually get is a world that looks less risky, where the US upswing moderates but is extended by this second leg of fiscal and deregulation. And then in that world, well, at least ex post, you say, well, US did look quite expensive. I always find that the characteristic sign of a bull market is when you could say, well, suppose if we fast forward 6 months and things have corrected, would it be easy to explain why things corrected? Well, yes, it wouldn't be a mystery. You know, the 10-year rate in the US goes up 50 basis points and suddenly the S&P corrects. Well, bit of inflation risk from tariffs. I mean, that plays out in an obvious way.
Yes, it does. But I think you can think of it other ways as well, because there's been no earnings growth elsewhere. And the earnings growth has been concentrated in a handful of stocks, so that's where all the flows have gone. Put an alternative earnings growth story on the rest of the world, and the flows start to move the other way. And so, you know, they become funding stocks, basically, the Mag 7. So instead of being the only thing to buy, they're the only thing to chip away at to fund everything else.
Well, we should start bringing things to a close. So next year, it's anyone's guess exactly what happens with the new administration, especially one with such a far-ranging set of policy proposals. But my sense is you're reasonably constructive, even if we have a correction in the US. It's mid-cycle slowdown. It's not recession. Probably places like the UK, we go back to this housing market upswing where we lend into the housing market. That probably gets the market excited. In hindsight, it won't be wise to do so, but that's just the nature of things there. And any final comments that you would like to add?
Well, I think the US administration is, I mean, I do think there's going to be a bit of a mid-cycle slowdown, but I think a very exciting agenda they've got. The tariffs bit, okay, sure.
Misguided, yeah.
I'm not so keen on that. I can see why they think it's going to do what it's going to do. I'm not sure it will, but the shrinking government, terrific. I mean, I'm an old school liberal. I think, you know, the government should be small, not large. And the Thatcher type liberal rather than the sort of modern progressive liberal. And so, I love this Doge idea. I wish we could have one here. I'm staggered that a government turns up. We get a new government here, and we've got the highest share of government spending as a share of GDP since World War II, pretty much. And they want to make it bigger. I mean, it's just nuts to me. There's so much inefficiency you could clean up. Governments, sadly, are not good at being productive.
But Elon Musk's on the wrong side of the Atlantic. And do I guess that you think probably the Fed's going to go a little bit faster than the market expects?
I think so, yeah, because I think as we said earlier, it's the most obvious monetary inflation that we've ever seen, and money supply growth is pretty much zero and has been for quite a while. So that should kill inflation to the downside, get more cuts, and we get this mid-cycle slowdown as well. Get more cuts.
So, where can people find you?
Yeah, well, website www.longvieweconomics.com. Where we, sell all sorts of stuff that hopefully helps people make money and work out what's going on in the world. On Twitter at Longview Econ, and we're also at Lview Econ. I get a bit confused. Longview Econ and Lview Econ. Then on LinkedIn, on Substack, Chris Watling on Substack. I mean, you name it, we're everywhere.
Brilliant. Well, thank you so much for joining me. It's been a real pleasure, a really fascinating chat. And
thank you very much. I appreciate it. Thank you.